The SKEW Index. Hello, welcome to the Black Swan. I am your human Labrador, looking out for you out there to see what's really going on so that you can educate yourself in the stock market. So, 7 days ago, a number most investors have never heard of quietly crossed a line, and it has only crossed a handful of times in the last decade. Every single time it happened before, the S&P followed with a real drawdown within months. Not always a crash, but always a drop worth noting about in advance. That number is called the SKEW Index. July 22nd, it hit 150. Today, July 29, the market took the tumble that number was warning about. The S&P fell 1.5%. The Dow dropped 2%. The SKEW Index itself has pulled back to 139. So in the next 10-15 minutes, I'm going to show you exactly what this chart is, walk you through every prior time it flashed this signal, going back to 2016, and then give you a clear level-headed playbook for what a prepared investor does next. This isn't about fear, it's about being the person in the room who knows what's coming, so that we keep monitoring that index and then see what we could do next. So before we dive in, if you're new to this channel, hit subscribe. This channel is built entirely around finding signals like this one before they show up on the evening news. Probably hasn't come up anyway. They wouldn't go in that much detail. And if you want the full data beyond every chart I showed today, the complete numbers, everything that's going on, please join my membership tier. I have two tiers. I have the Wealth Builder and I have the Tactician. This gives you 6 tools. This gives you an additional 5. Now let's get into it. So what is the SKEW in plain English? Here's a simplest way to think about it. The VIX index, which most people have heard of, measures how much movement option traders expect in the market over the next 30 days. Up or down doesn't matter, just movement. The SKEW is different. The SKEW measures something more specific. How much extra money professional traders are paying right now for protection against a sudden severe drop. Not a normal down day, a real shock. CBOE actually nicknamed this the Black Swan Index when they built it, because that's precisely what it's designed to detect. The market quietly pricing in the odds of an outlier event well before that event shows up in the headlines. Think of it like this. Imagine a neighbor where everybody buys the same basic insurance policy every year. Most years, nobody adjusts anything. But every so often, people quietly start buying extra flood coverage, right? Even though the sun is shining outside. That behavior change tells you something. It tells you somebody somewhere is seeing a risk you can't see yet. SKEW is that flood insurance number for the entire stock market. A reading of 100 means nobody is paying attention for that protection. A reading near 150 means meaningful number of sophisticated investors are. As of today, SKEW sits at 139.55, down sharply from 150 just 5 trading days ago, but still elevated versus its own 12-month average of between 132 and 160. So to read this chart, the dark line is basically on the left is the S&P 500. And the light blue shaded area below, measure on the right, is the SKEW Index. The gold dashed line, basically marks the signal threshold. Every time the blue shaded pokes above the gold line, watch the dotted line closely in the weeks that follows. The gold circles mark the moment SKEW crosses 150, and a real drawdown follow within about a month. So basically what we're saying to you now is be careful, watch that SKEW. That's an important factor. And if you're a member of my channel, I will be adding that indicator on the board every day at 9:30. I speak to both my Tactician and my Wealth Builders. We go over these numbers. You gotta watch what's going on. You gotta understand what's going on so that you're not surprised. Let's take a look at the historical perspective. Let's go through every prior instance because history here is doing a lot of the talking. In July 2018, SKEW pushed above 150 while the market was still grinding higher. Within months, the S&P fell 16 to 19% as rate hikes and trade war headlines collided. In January 2020, SKEW spiked again. 6 weeks later, COVID hit and the market fell 30% in one of the fastest drawdowns in modern history. To be clear, SKEW did not predict a pandemic. What it predicted was the market pricing a tail risk was unusually elevated. And when the shock did arrive, the move was severe. And in November 2021, the signal fired again, right as the Federal Reserve was pivoting toward the most aggressive hiking cycle in 40 years. The S&P fell 15 to 22% over the following month. And of course, in November 2024, it fired once more, and a 13% correction followed in the summer unwind that year. So if you look at the chart, each bar shows the peak to trough, right, decline in the S&P 500 following a SKEW above 150. The gold bar, right, is where it is right now. So here's the honest, important nuance. This signal has never once been wrong in the direction it pointed. But the size of the move has varied enormously, from a 9% wobble to a 30% collapse. SKEW tells you to pay attention. It does not tell you the size of what's coming. That's the uncertainty we have to sit with, and it's exactly why we built a range of outcomes rather than a single prediction. But to be clear, we're looking at is a warning. I mean, these guys are basically black swan people, and they converted that into an index, and that's what you need to watch out for. So what is really happening right now? First, the Federal Reserve held interest rate study on July 29, but 3 committee members dissented and voted for a hike instead. That is a genuinely hawkish split, and long-term treasury yields responded immediately. Look at the 30-year, look at the 10-year. Second, tension in the Middle East escalated sharply. Reports of joint strikes and intercepted missile attacks pushed oil prices sharply higher, with Brent crude topping $90 a barrel. That is a kind of geopolitical shock that shows up first in options pricing and only later in the headlines everyone reads over breakfast. Third, and separately, a real slide in chip and technology stocks is underway. The Nasdaq 100 has now pulled back roughly 11% from its record high, technically entering correction territory even as some big name like Microsoft posted strong cloud growth right alongside weaker guidance for others like Meta. So the way you read this chart is this is a close-up of the last 7 months. The shaded band is the 52-week trading range for the SKEW, from 132 to 130.62, right? You can see the spike from 150 on July 22nd and the pullback to 139 today alongside the actual S&P 500 and VIX reading from this week's close. So put together, that's a rate story, a geopolitical story, and a sector rotation story, all landing in the same 5 trading days. That's precisely the kind of conversion that tends to show up first in the SKEW. And again, the word that comes out all the time is story. This is a narrative story. We're trying to figure out what the market is thinking, what we're thinking about. Basically, every day in the market, you have between 1 to 5 million people, analysts, traders, portfolio managers, right, in the US that are trying to figure out what's going on in the stock market. What do? They keep looking, they keep thinking, and that's what you have to decide. You're in a room with 1 million people. You have to decide, what are these people saying? They're all talking at the same time. So the positive case. This is where I want to be constructive, because that's the whole philosophy of this channel. A pullback like this is not automatically bad news for prepared investor. It's repricing. Notice something is that in the last chart, even within this week's drop, the S&P 500 is still up meaningfully from where it started the year, and well above every prior SKEW signal starting point we just walked through. This is a market correcting from strength, not collapsing from weakness. Corporate earnings, as JP Morgan's own tactical position and desk noted this week, remain strong. The dollar has been softening, which historically support risk asset once volatility settles. And bond yields, while they spike on Fed Day, then stabilize once the market fully prices in the Fed's next move. Historically, every single instance we covered today, 18, 20, 21, 2024, was eventually followed by the market making new highs. So the SKEW signal has never marked the end of the story. It marks a chapter of turbulence inside a much higher trend.